Stagflation is a concern for a lot of investors, the notion that we have high inflation and that economic growth is slowing down. In fact, the Atlanta Fed is projecting slower growth in their GDP forecast. So what do you think? Is this a concern for you? Is stagflation a concern for an investor?
Certainly in rate of change terms, that's something I'm monitoring and that have basically had a stagflationary outlook since we've entered quarter three. And so basically, if you look at most types of economic growth, they're still positive but decelerating compared to their peak in quarter two, while inflation has obviously ramped up. And historically, one of the triggers for economic weakness tends to be very, very high energy prices. And we've seen that in the United States to some extent, but then especially we're seeing it in Europe and China, where high input costs can trickle through the rest of the economy and force contractions. We're also seeing supply chain shortages. And so we're in an environment where, if anything, inflation is partially being masked by shortages. So if there's a shortage of something, the price, it doesn't get fully reflected right away. And so basically customers and businesses are dealing with lower quality in their supply chain situation, in their service offerings, while still dealing with pretty high prices.
How does stagflation directly impact, let's say, the stock markets or cryptocurrencies or precious metals?
So stagflationary environment obviously can be somewhat challenging for the stock market. It's also generally rough for the bond market. So right now we're seeing in bonds, for example, that yields are well below their inflation rate. So anyone holding cash or bonds is getting devalued over a period of time. And with stocks, it's kind of hit or miss. Obviously, the financials and the energy sectors are doing pretty well. Whereas you've seen some weakness out of some of the more highly valued unprofitable tech stocks. Basically, stock markets have been a mixed bag, especially when you look globally. And so those are the areas where there's certainly risk to the downside. Commodities tend to be some of the best performing assets in stagflationary environments. It's important to realize though that they're volatile, so it's not a straight line. So even if you invested in commodities in the 70s, which obviously did very well, there would have been some wicked drawdowns during that time. And so that's kind of the area that I'm focused on is more that commodity area, more of the value stocks, the real assets, appropriately priced real estate in some markets still. I think there are attractive hard assets out there as part of kind of an overall portfolio mix. So I think the major risks are these energy shortages that we're seeing, which is kind of the catalyst for stagflation. We also have to see how different central banks start dealing with the fact that they have inflationary environments. And so one of my big themes going into this year was that we probably would get substantial inflation, but yields would still be pretty low because that's essentially what happens when you have public debt as high as this is, which makes it a very different environment than the 70s. So in the 70s, debt as a percentage of GDP was very low, so they were able to raise interest rates very, very high to counteract inflation. Whereas if you go back to, say, the 1940s, when you had all that war debt, when they ran into high inflation, they just pinned rates near zero anyway and pretty much let some of it burn away in inflation. And so I kind of am looking at that situation, but a risk is that if they do try to tighten, which they very well might, that could obviously put some downward force on risk assets across the board. And that goes back to this thing where inflation is rarely a straight line. There are all these pushbacks against it that happen along the way. And so investors have to make sure that they understand their time horizon if they're a trader or an investor. I mean, basically, that would be quantitative easing while raising interest rates. That's something that we've not really seen central banks try. I think that's still somewhat of an inflationary impulse when it's combined with that fiscal spending, because basically you're adding currency to the system without extracting it from the system. And so, with the Fed, for example, they've already indicated the order that they want to go in. They want to taper asset purchases, and then they want to be slower to raise rates. And they also, they have that reverse repo facility that's full, and they have normal repo facilities ready to go should that spill back the other direction. And so they've clearly set a foundation where they want to try to tighten, and yet they still have these buckets to absorb either periods of excess liquidity or insufficient liquidity. And so I think they've designed about as good of a system they can get for at least an attempt at tightening.
An article about TIPS, the Treasury Inflation Protection Security. Is that one of the ways we can hedge inflation? Is that the optimal way? Is that not an ideal way? What do you think?
I view it as not being an optimal way, but if you have a mandate to own bonds, or because you're trying to reduce your volatility of your portfolio by owning some bonds, TIPS are kind of like the least bad bonds in this environment. And so the issue with TIPS is that they have lower yields than normal bonds, and actually they have negative yields. And so even though they're indexed to inflation, when you combine it with that negative yield, you're guaranteed to underperform inflation. However, the caveat is that if you get much higher inflation than the treasury market is currently pricing in, then TIPS will do less poorly than normal bonds.
Uh,
And so I do think that, for example, short-term TIPS are a useful allocation, but that there are better volatility, inflation hedges if investors are willing to put up with that higher volatility that they come with.
Now, TIPS, are they indexed to CPI or are they indexed to inflation expectations from the market?
Yeah, they're indexed to headline CPI, and
Okay.
so, but the way that they're priced is obviously that's where we come up with inflation expectations. So
Okay.
inflation expectations are based on looking at the yield differential between TIPS and a normal treasury of the same duration.
Explain this phenomenon to me, Lyn. I've graphed this myself. The TIP ETF from iShares, I believe. That price chart has a very close correlation to gold. In fact, just taking the last 5 years, for example, the correlation coefficient has been 97% according to my calculations. But however, if you take just the gold price versus the CPI, that correlation is much less strong. In fact, it's rather weak. How do you explain that?
So part of it, I think, is algorithms and financialization. And so gold is basically this investment that we're based on, forward expectations. It has a pretty long kind of duration outlook, you can call it. And so when we look at, say, like short-term inflation, investors don't necessarily rush into gold. Now, I probably would have expected that more would have bought by this point, judging by how high inflation is. But, generally the stronger correlation is with those inflation expectations, because that's the same sort of forces that determine how much investors want to allocate to bonds. They basically are looking past kind of like, say, year-long inflationary shocks. Now, obviously, as this has dragged out, people have begun extending their expectations for how long inflation will last. Both the Federal Reserve has changed their narrative to some extent, and investors. So the longer that goes out, those inflation expectations can start to rise. Another kind of complicating factor is that the Federal Reserve is buying both normal treasuries and TIPS as part of their asset purchases. And so those are not necessarily the most accurate markets to follow. So for example, if you look at, say, a ratio of the copper to gold ratio and compare it to 10-year yields, they've been pretty well correlated, kind of lines on a chart, but you'll see a pretty significant divergence ever since the Fed kind of has done this very large asset purchases. Basically, that chart would have implied higher 10-year treasuries than we're seeing now, but the Federal Reserve took a lot of supply off the market. And so there are a couple challenges with trying to estimate what is the quote unquote the market thinking of in terms of inflation expectations when you have the Fed's thumb on the scale.